It is Friday, January 16th, 2026, and if you are tuned in today, you know exactly why we were dropping a special emergency deep dive. Riot Platforms, ticker RIOT, is experiencing what we can only describe as a fundamental, violent re-rating. The stock is up roughly 7.5% to 8% in early trading, hovering right around $17.83 on just massive volume.
And this is not just noise. For years, if Bitcoin moved, Riot moved. Their correlation coefficient to PTC was nearly 0.9. Today, we are seeing a true, sustainable decoupling because the market is finally beginning to price this company not as a volatile crypto miner, but as a critical infrastructure landlord for the artificial intelligence revolution.
Wow.
The conclusion we've reached is simple. This price surge isn't the end of the move, it's likely just the beginning.
Okay, let's unpack this. We've been pouring over the 8Ks, the press releases, and, the analyst notes that hit the wire today.
Right?
This isn't just one announcement. It's a triple whammy of catalysts that transforms the company's structural identity overnight.
That's right.
So walk us through the three major pieces of news that forced this re-rating.
First, they solved a major structural de-risking step. Riot has acquired the fee simple interest in 200 acres at their flagship Rockdale, Texas site.
Fee simple, so they own it outright.
They own the dirt. They paid $96 million for the land, moving themselves from a high-stakes tenant to the unquestioned landlord. When you are building critical infrastructure, owning the ground underneath it is paramount.
Second, and this is crucial for the management evaluation, how did they pay for that $96 million land acquisition? Because Riot's historical method of fundraising has, frankly, been a major sore spot for shareholders.
And that's where we see the maturation. This transaction demonstrates the most sophisticated capital allocation move they have ever made. They funded the entire acquisition by selling 1,080 Bitcoin from their balance sheet.
So no new shares.
No new shares. They recycled a volatile digital treasury asset, a non-yielding asset, into hard real estate that underpins a long-duration contract.
And the third piece, the headline news, the massive institutional validation that shifts the entire narrative.
The 10-year data center lease and services agreement with Advanced Micro Devices, AMD.
AMD.
A titan, exactly. AMD is a silicon titan. This deal is not speculative. It's confirmation that the largest chip makers in the world view Riot's energized capacity as mission critical. The initial deployment is substantial, 25 megawatts of critical IT load.
And that's starting when?
Immediately. It's happening now.
And that 25 megawatts alone carries a strong revenue expectation, I'd imagine.
It does. Over that initial 10-year term, Riot anticipates $311 million in guaranteed contract revenue. But the real leverage here is the scale of the optionality attached to that contract.
Okay, here's where it gets structurally defining. That contract includes massive expansion options.
Yeah. Yes. That agreement grants AMD the potential to expand that deployment up to a staggering 200 megawatts. If AMD fully exercises those options, and given the scarcity of power they likely will, that initial $311 million revenue stream could swell into a $1 billion revenue stream over the life of the contract. This move fundamentally transforms the entire architecture of the firm overnight, introducing a long-duration utility component.
So our mission today is no longer just analyzing a Bitcoin miner. We have to analyze a diversified infrastructure play. We need to determine the intrinsic value and see if the market, even at $17.83, has fully priced in this corporate metamorphosis. We were applying the foundational principles of Benjamin Graham and Warren Buffett. We need to find the margin of safety, conduct a moat audit, and calculate the sum of the parts value to see if substantial upside remains baked into this new reality.
Our core thesis is what we call the mullet strategy. Bitcoin volatility in the front, stable, long-duration infrastructure revenue in the back. The goal is to see what the component parts are truly worth, especially the previously unvalued asset of available power capacity.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. We must begin with a foundational understanding. Before this morning's news, if we were setting up this deep dive, how would you define Riot's core business model? Were they a technology company or were they primarily an energy play?
Riot pre-news was first and foremost an energy arbitrage company disguised as a technology operation. Fundamentally, Bitcoin mining is a commodity production business. You have zero pricing power. The price of your product, Bitcoin, is dictated by the global market. To win in a commodity business, your sole focus must be to become the absolute lowest cost producer.
And in this particular commodity business, the critical raw material is electricity.
Precisely. They buy massive amounts of power in bulk, primarily through the ERCOT grid in Texas under long-term contracts. They feed that power through their thousands of ASIC miners to produce Bitcoin. But the differentiator, the original and foundational moat, was not the efficiency of their machines, it was their power moat.
Detail that operational advantage for us, because understanding this is crucial. This advantage applies equally whether they are mining Bitcoin or hosting AI servers.
The advantage lies in scale and strategy. They operate colossal facilities. Rockdale, which currently runs at about 700 MW capacity, and Corsicana, their massive site scaling toward a full 1 GW, or 1,000 MW. Their strategic genius is their full participation in the ERCOT demand response program. This is the heart of their profitability.
Okay, how does that program practically function on a hot summer day?
When the Texas grid is stressed, say during a blistering heat wave where air conditioners use peaks, the spot price for power can spike dramatically. We are talking about power surging from a contracted bulk rate of, say, $50 per megawatt hour to $3,000, $5,000, or even $9,000 per megawatt hour.
So those price levels, their opportunity cost calculation flips entirely.
Absolutely. The profit they could generate from mining Bitcoin suddenly pales in comparison to the profit generated by selling their contracted power back to the grid at spot prices. They become, instantaneously, a flexible, dispatchable power plant. They shut down the miners, they are what we call interruptible load, and essentially stabilize the Texas grid, earning immense power credits in the process.
Let's ground that in real numbers. What did this strategy yield for them in Q3 2025?
The key data point is that in Q3 2025, Riot generated $31 million in power credits.
31 million.
Yes, that is a massive operational offset. Those credits are accounted for as contra expenses, which means they directly subsidize the cost of the electricity they did use for mining.
And that subsidization drives their all-in cost of power down to levels competitors simply cannot match.
Dramatically so. In Q3 2025, their all-in power cost net of those credits was driven down to just 3.2 cents per kilowatt hour. In August 2025, during the height of the curtailment period, it dipped as low as 2.6 cents per kilowatt.
Wow. And what's the U.S. average for context?
To put that into perspective, the U.S. industrial average power rate is often closer to 6.5 cents per kilowatt hour. This durability protects their margins from both Bitcoin volatility and rising energy costs, which is, the definition of a deep moat.
That is the foundation. Now, the AMD deal forces us to analyze the strategic bifurcation, the mullet strategy. We now have two arms drawing power from that same reservoir. Let's look at the active arm, the legacy Bitcoin mining business.
The active arm is high beta, high volatility. It is intensely capital intensive because the machinery, the ASICs, depreciates incredibly fast. The technological cycles are punishing. An ASIC bought in 2021, state of the art then, is functionally a paperweight today in 2026.
Can't compete.
Can't compete with the latest generation. Its profitability is entirely dependent on the highly volatile price of Bitcoin, currently around $95,000.
And the passive arm, the new data center and high-performance computing hosting side.
This is the low volatility, long duration stream that the market is just starting to price in. The physical infrastructure, the building shells, the cooling systems, the substations last 20 to 30 years. Critically, the tenant, AMD, is bringing their own cutting-edge AI chips. Riot is not exposed to the technological obsolescence risk of the processing unit itself.
Right.
This provides long-duration, predictable, and sticky revenue anchored by the 10-year lease with a globally creditworthy counterparty.
So the moat is shifting. It's moving from just cheap power to controlling a different, more valuable, scarce resource in the 2026 market.
It shifts to available, energized power scarcity. This is the key barrier to entry today. If a major hyperscaler, a firm like AMD, or a future tenant like Microsoft or OpenAI needs 100 megawatts or more of capacity today, they hit a monumental roadblock, the U.S. grid interconnection queue.
Walk us through the reality of that queue. Why can't they just build their own plug?
The queue for large-scale load interconnection in the U.S. is notorious. It involves permitting, transformers, transmission line upgrades, bureaucratic approvals. Due to grid congestion and supply chain issues for critical components, that wait time is typically 3 to 5 years minimum, sometimes longer.
3 to 5 years.
So if you have billions of dollars worth of AI chips arriving next month, ready to process data, a 5-year wait for a plug means 5 years of lost revenue.
That is a staggering obstacle for any company trying to gain an edge in the AI race.
Exactly. Riot doesn't face this. They have 1.7 GLUBD of approved, energized capacity ready to plug in today across Rockdale and Corsicana. This scarcity creates immense pricing power for Riot's infrastructure arm. This is why we say they are moving from a commodity business, Bitcoin mining, to a franchise business in infrastructure. Supply, which is the energized capacity, is locked up and finite, and demand for AI compute is essentially infinite.
And the $96 million land acquisition directly reinforces this new moat.
It completes the de-risking process for these massive institutional clients. Owning the 200 acres fee simple at Rockdale removes all landlord risk. When AMD installs hundreds of millions of dollars of proprietary next-generation AI hardware, they need absolute legal certainty. They need to know that their operation is not subject to the whim of a third-party lease agreement. This acquisition sends the strongest possible signal of stability to the hyperscale community.
So, the infrastructure arm gains pricing power because they are one of the few places in the U.S. that can offer immediate, massive grid connection.
That is the transformation. It is the immediate fulfillment of a massive, critical infrastructure demand.
But we cannot ignore the complexity of the transition. Running an interruptible load facility, where you can just shut down the miners when power gets expensive, is vastly different from running a high-performance computing data center, which is critical load. The latter demands 5 nines of uptime, 99.999% reliability, and far more sophisticated continuous cooling.
That jump in operational complexity is the primary execution risk we must monitor. Bitcoin miners tolerate downtime. AI clients do not. A cooling failure or power interruption can cost a hyperscaler millions in lost compute time, potentially triggering severe penalties in a service level agreement, or SLA. That's why the $89.8 million facility retrofit is critical. They are upgrading cooling and redundancy systems to meet the stringent demands of AI chips, which run significantly hotter than ASICs.
But the management team hasn't been idle. They brought in specific talent, right?
Yes, they proactively hired dedicated data center veterans like Jonathan Gibbs, their chief data center officer. And it's important to read the contract terms. It's a lease and services agreement. Riot provides the stable power, the cooling, and the infrastructure. AMD typically retains the responsibility for managing the proprietary hardware and software stacks.
Which mitigates some of Riot's risk.
It mitigates some of their deep operational burden, at least initially. The management is acknowledging the risk and bringing in professional resources to mitigate it, which is the only way this pivot works.
Chapter 2. Management evaluation. Okay, we've nailed the business model and the structural shift. Let's move to Chapter 2. Management evaluation. The quality of any business ultimately rests on the judgment and capital allocation skills of the management team. How do we grade Jason Les and his executives?
We have to look at the signals they were sending even before the AMD deal dropped. The most significant personnel signal arrived on January 2nd, just 2 weeks ago, the CFO transition. Colney Yee, who provided financial stability, moved to a senior advisor role, and Jason Chung, the head of corporate development and strategy, stepped into the CFO seat.
Why is promoting the transaction guy such a crucial signal?
It signals a change in financial ambition. Jason Chung is an ex-Nomura investment banker. He is a specialist in complex financial engineering, M&A, and structuring large-scale debt financing for infrastructure projects. You don't put a corporate development specialist in the CFO role if you're planning to continue simple Bitcoin mining. You do it when you are planning aggressive, large-scale infrastructure growth, structuring complex joint ventures with hyperscalers, and executing massive infrastructure debt deals to fund the 1GW expansion at Corsicana. This transition was the essential precursor to the AMD deal.
That makes sense for the future, but we have to audit their historical behavior. Let's be honest. Riot has a major strike against it regarding shareholder treatment. The massive reliance on at-the-market, or ATM, equity offerings led to severe shareholder dilution.
That is a fair criticism, and it's why my historical grade for shareholder friendliness is low. They printed shares consistently to fund the massive capacity build-out, especially at Corsicana, and existing shareholders bore the cost of that expansion.
Wait, let's pause on that. You gave them an A for strategy earlier, but for years they diluted shareholders relentlessly to fund this capacity. Why is one strategic asset sale today enough to negate years of poor shareholder friendliness? Isn't that B grade far too generous, given that dilution was the primary reason the stock lagged Bitcoin?
That's a sharp challenge, and it's why the trend is so important. The A is for strategy, the identification and execution of the infrastructure pivot. The B accounts for the historical execution flaws on capital structure. But the pivot demonstrated today with the $96 million land deal is exactly the type of accretive, sophisticated capital recycling that proves they are learning. They didn't issue new shares, and they avoided expensive debt. They used their balance sheet intelligently.
Let's quantify the intelligence of that move. They sold 1,080 Bitcoin to raise $96 million cash. What was the financial alternative?
The alternative in this high interest rate environment, remember the 10-year Treasury is at 4.19%, would have been securing debt. To finance $96 million using, say, a 7% debt facility over 5 years, that would imply annual interest expenses exceeding $6.7 million. That is dead money. By selling 1,080 BTC, they swapped a non-yielding volatile asset for a hard asset that is immediately productive and supports a guaranteed revenue stream.
So they converted idle speculative capital into active yielding capital.
Exactly. It increased their return on invested capital. This demonstrates a maturity of capital allocation that we haven't seen consistently before. And they only used about 6% of their total holdings for this transaction, preserving their massive liquidity buffer.
And what does that buffer look like today, that fortress balance sheet?
It is the ultimate competitive advantage, especially against leveraged competitors. As of the end of 2025, they hold roughly 18,005 Bitcoin. At today's implied price of $95,000 per coin, that treasury alone is worth approximately $1.71 billion. Add to that around $330 million in unrestricted cash.
Nearly $2 billion in liquid assets or cash equivalents.
And crucially, they have minimal long-term debt. This flexibility is priceless. In an environment where the cost of capital is high, the ability to self-fund the multi-stage, multi-year expansion required by contracts like AMD's without resorting to expensive borrowing or dilutive equity offerings. It puts them miles ahead of the competition.
So, on balance, we see a strategic management team that is learning from past mistakes and executing a high-level pivot.
Yes. I maintain the A for strategy. The infrastructure pivot is brilliant and necessary. The B for historical shareholder treatment stands, but the trend in capital allocation is overwhelmingly positive towards sophistication.
Chapter 3, Financial Health. Now we open the books in Chapter 3, Financial Health. We need to cut through the significant accounting noise that confuses most investors when they look at a Bitcoin miner's income statement to find the core operational durability.
This is the most crucial part for an intrinsic value assessment. You cannot trust the headline net income figure alone. Let's use Q3 2025 as our example. Riot reported total revenue of $180.2 million. Adjusted EBITDA was $197.2 million, and net income was $104.5 million.
Logically, how can adjusted EBITDA be higher than total revenue? That just doesn't happen in most industries.
Welcome to FASB ASC 35060 Accounting Rules. The Financial Accounting Standards Board requires Bitcoin mining companies to mark their Bitcoin holdings to fair market value mark-to-market every quarter. Since Bitcoin rallied significantly in Q3 2025, Riot booked a massive non-cash paper gain of $133.1 million on the change in fair value of Bitcoin.
So the reported net income of $104.5 million was entirely fabricated by a non-cash accounting adjustment based on the BTC price movement.
Precisely. If you strip out that $133.1 million non-cash paper gain, the underlying operating business, purely from mining activity, was running at a slight loss or near break-even in Q3 2025. This underscores the immense volatility they face and why the transition to stable, guaranteed revenue streams like the AMD lease is so vital for financial health.
Let's drill down into the core durability of the legacy mining side. What was the real direct cost to produce one Bitcoin?
In Q3 2025, the direct mining costs were calculated at $46,324 per Bitcoin produced. That cost is high due to the ever-increasing network difficulty. It takes more computational power to win a block. However, compared to the current market price of Bitcoin at $95,000, they still generate a very healthy gross margin of approximately 51%.
But the real magic, the real durability, doesn't come from the raw margin. It comes from the ability to cut that cost basis further.
Absolutely. It circles back to the power mode. The $31 million in power curtailment credits earned in Q3 2025 are the mechanism. These credits are not marginal. They are contra expenses that directly drive down the cost of goods sold. They are the driving force that pulled the all-in power cost down to that critical 3.2 cents per kilowatt.
That is the crucial metric for survival. If the operating cost is 3.2 cents per kilowatt, they maintain profitability, where competitors running at 6 or 7 cents per kilowatt are forced into bankruptcy or must shut down their machines entirely.
That is the foundation of their resilience, and why they can endure the long-term margin compression expected from the Bitcoin halving event. They are positioned to survive market volatility that will crush higher-cost operators.
Now, let's look forward to the texture shift in their 2026 revenue with the AMD deal. How would this fixed revenue stream impact the overall quality of earnings, even though it's small initially?
The initial $31 million per year from AMD is indeed modest compared to the $180 million they generate quarterly from mining. However, its quality is exponentially higher, and the market values it differently. Mining revenue is variable and commodity-based. Data center leasing revenue is fixed, long duration, and secured by a blue-chip counterparty.
And what does that mean for the valuation multiples?
Data center leasing and HPC hosting command much higher EBITDA multiples, often 60% to 70% margins. And analysts capitalize those cash flows differently. The market assigns much higher valuation multiples to these stable infrastructure cash flows than to volatile mining revenue. This improvement in the quality of earnings means that the company's overall valuation multiple will expand even if the absolute revenue addition is small at first.
This shift must be forcing analysts to revise their models immediately.
Definitely. Analysts had a consensus revenue estimate for 2026 of around $757 million pre-deal. I expect that to rise immediately toward $800 million plus, driven by the quality improvement and the confidence the AMD deal brings. The visibility of future earnings has improved dramatically.
And finally, let's close this financial chapter by re-emphasizing the liquidity position, the ability to fund expansion.
The ability to self-fund is Riot's superpower. The $330 million in unrestricted cash, the $1.7 billion in Bitcoin treasury, and minimal debt means they have an unprecedented capacity to execute on the multi-stage, multi-year, $1 billion potential AMD contract without having to beg Wall Street for capital or dilute existing shareholders further. They are masters of their own destiny.
That concludes our deep dive into the business fundamentals, management quality, and balance sheet strength. When we return, we will shift gears dramatically to market psychology, the geopolitical landscape, and the crucial sum of the parts valuation that determines the stock's true intrinsic value. Like and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. We return now to Chapter 4, Market Sentiment. Before this morning, the stock was in a holding pattern. What was the prevailing narrative around Riot, and why was the stock stuck in the mid-teens?
The narrative was frustration and fear. Despite Bitcoin running hot in late 2025, Riot stock was lagging badly, anchored between $12 and $15. Investors were terrified of two things. First, the continued history of shareholder dilution via those ATM offerings, and second, the looming specter of the halving hangover.
Explain that hangover briefly.
The Bitcoin halving, which occurred in 2024, significantly reduced the reward miners receive for securing the network. This structurally compresses margins industry-wide unless the Bitcoin price rises dramatically. Investors saw cost compression coming, and they saw management diluting them, so they sold first and asked questions later.
It seems like those fears have been violently overridden in the last 24 hours. The narrative shift must feel like vindication for the long-term holders.
It absolutely is. The shift was catalyzed and validated by institutional backing. Piper Sandler, a major Wall Street analyst firm, released a note just yesterday reiterating their overweight rating and setting a $26 price target. That note was based entirely on the thesis that Riot was a sleeping giant.
They called the company a giant simply because of its undervalued power capacity.
Exactly. Piper Sandler argued the market was massively undervaluing Riot's 1.7 GW of energized capacity. The fact that Riot delivered the AMD deal, a deal that proves the capacity is valuable to hyperscalers, within 24 hours of that note hitting the street forces every other investment bank to immediately remodel the company. They cannot rely on old Bitcoin-only spreadsheets anymore.
Let's discuss the immediate market mechanics. This news must have blindsided the short sellers.
It did. Short interest has been elevated across the entire crypto mining sector. Many hedge funds use these stocks as a highly liquid proxy to hedge their long Bitcoin exposure. Today's massive volume, over 15 million shares traded in the first few hours, far exceeding the average, is the textbook definition of a short squeeze catalyst. Shorts who are hedging are desperately covering their positions, which amplifies the upward pressure from new money flowing in.
And what about the retail investor? How are they reacting to the AMD deal?
Retail investors are responding with enthusiasm and seeing this as Riot growing up. It validates the long-held retail thesis that these miners aren't just speculative crypto plays. They are essential, undervalued infrastructure for the next great technology boom. Artificial intelligence. Investors who felt they missed the massive run-up in NVIDIA and other chip makers are now aggressively looking for exposure to the next layer of the stack, the power in infrastructure, and Riot has now firmly planted itself in that AI rotation basket.
Chapter 5, Ownership Structure. Let's turn to Chapter 5, Ownership Structure. Who are the big institutional players who already own the stock, and perhaps more importantly, is this new dual-engine business model making Riot palatable for a new class of investors?
Riot is one of the most liquid and heavily institutionalized stocks in the sector, which makes it a favorite for passive index strategies. We look at the universal owners, the funds that own everything.
Who are the big three providing that bedrock stability?
The Vanguard Group holds a substantial 10.6% ownership stake, representing around 39 million shares. BlackRock Inc. holds a significant 7.8% stake, roughly 29 million shares. And FMR LLC, or Fidelity, owns about 5.5%. These funds provide necessary stability and liquidity, ensuring the stock can handle large institutional transactions.
What about the active players, the quant and arbitrage funds that often trade the volatility?
We see significant positions held by quantitative trading powerhouses like Jane Street Group and Susquehanna International. Their presence ensures extremely high trading liquidity. These firms are likely using Riot for sophisticated arbitrage strategies, treating the divergence between the stock price and the underlying Bitcoin spot price, helping to keep the market efficient.
But the real opportunity is the mandate shift. Riot needs to become attractive to funds that previously had a hard veto on anything labeled crypto miner.
Exactly. The AMD deal fundamentally changes the mandate fit. Riot is migrating out of the narrow crypto category and into the much larger, more stable digital infrastructure category. These are funds focused on real estate, utilities, and reliable, long-duration cash flows. This reclassification makes Riot palatable to new pools of capital that couldn't touch the stock before. Think infrastructure REITs or dedicated technology infrastructure funds. The inflows from this mandate shift could dwarf the short covering we are seeing today.
Let's discuss insider activity. Did management sell into the run-up or before the news?
Insider ownership is relatively low, with about 94% held publicly or institutionally. Executive compensation is stock-heavy, which is good. We did see some selling in December 2025 by the outgoing CFO, Colin Yee, but given his transition to a senior advisor role, that was widely viewed as standard estate planning and not a red flag regarding the company's prospects.
And the critical signal.
The critical signal is the complete lack of selling by insiders immediately before or after today's AMD announcement. That indicates strong, unified confidence in this catalyst and the long-term strategic pivot they are executing. If they believe $17.83 was the top, we would have seen pre-news filing. We did not.
Chapter 6, Risk Assessment. We have laid out an incredibly compelling bull case, but we must now scrutinize the headwinds in Chapter 6. Risk Assessment. The biggest macro risk facing any U.S. domiciled technology company in 2026 is the geopolitical landscape, specifically President Trump's Trade War 2.0 and the tariff wall.
This geopolitical complexity, surprisingly, acts as a profound structural tailwind for Riot. The administration's trade policy creates a massive, almost custom-tailored advantage for U.S. domiciled power infrastructure.
Let's break down the tariff wall by the two types of hardware Riot uses, starting with the Bitcoin mining rigs, the ASICs.
Most high-performance ASICs are designed in China. Products originating in China face duties of 50% to 60%, which would make buying new miners cripplingly expensive. Riot's mitigation strategy was proactive. They anticipated this by shifting their primary supply chain, MicroBT, to manufacturing hubs in Southeast Asia, specifically Malaysia and Thailand.
And what are the tariffs on Southeast Asian nations for this hardware?
They're far more manageable, typically in the 20% to 30% range. More importantly, Riot locked in a massive order for 31,500 new generation miners before the worst tariffs hit. The risk here is not to Riot's current operational fleet, but to the industry's overall replacement cost.
So high tariffs on competitors function as a protective barrier for Riot.
Exactly. If a competitor needs to replace their machines today, their cost basis is instantly 20% to 30% higher than Riot's cost basis for its existing fleet. This effectively raises the industry's barrier to entry, protecting the value and operational lifetime of Riot's existing mining machines.
Now, let's pivot to the AI chips, the GPUs required for the AMD deal. The administration just slapped a major 25% tariff on advanced AI chips like the NVIDIA H200 and the AMD MI325. How does the AMD deal survive that?
This is where Riot's golden ticket comes into play. You have to read the specifics of the presidential proclamation regarding those tariffs. The administration has granted a crucial and highly strategic data center exemption.
Explain that exemption because it changes everything.
Tariffs on these advanced AI chips are explicitly waived if the chips are imported and utilized for compute capacity within U.S. data centers. The administration's strategic goal is straightforward. They want to ensure that the cutting-edge, mission-critical computational power for the AI race stays on American soil, within American borders, rather than being hosted by international rivals.
So Riot's 1.7 GW capacity essentially becomes a tariff-free zone. If a global tech firm wants to buy AMD MI325 chips tariff-free, they are essentially compelled to host that massive compute capacity in a facility like Riot's in Texas.
Precisely. This policy acts as a powerful funnel. It takes global demand for tax-exempt AI compute and directs it specifically toward U.S. domiciled infrastructure providers who have the energized capacity available now. The geopolitical landscape, typically a threat, has become a structural regulatory tailwind for Riot.
That is profound. But we must return to the one major operational vulnerability: the execution risk of the pivot, the difference between interruptible load and critical load.
This is the most complex risk factor. Failure to meet the quality of service required for critical AI load could be catastrophic. If a cooling system goes down for even minutes, AI chips can overheat and crash the entire compute block. Under a strict service-level agreement with a hyperscaler like AMD, Riot would face enormous financial penalties for uptime failures, potentially negating the profit from the lease.
So the $89.8 million retrofit isn't optional. It's a mission-critical investment in reliability.
Absolutely. That investment is necessary to buy down the execution risk. The hiring of professional data center operators and the strategic land acquisition are all components of this risk mitigation effort. The risk is high, but the management is demonstrating the commitment and capital to address it head-on.
Let's conclude this chapter with a full SWOT summary based on everything we've covered.
Strengths. Unmatched scale, that's the 1.7 GW of energized capacity available now. The fortress balance sheet with the 18,000 BTC treasury providing capital flexibility. And of course, the low-cost power moat, that 3.2 cent per kilowatt hour net rate.
Weaknesses.
The acknowledged history of shareholder dilution. Significant Bitcoin price dependency, it's still 90% of revenue today. And the non-trivial execution risk on the $89.8 million data center retrofit, requiring flawless operational transition to critical load standards.
Opportunity.
The AMD deal expansion, that potential $1 billion in revenue, strategic M&A of distressed, higher-cost miners who can't survive the halving, the massive AI sovereignty tailwinds created by the tariff exemption, and the 1 GW Corsicana site, which is just a huge undeveloped opportunity.
And finally, threats.
Long-term margin compression from the Bitcoin halving, ongoing regulatory risk related to ERCOT grid rule changes, and the persistent threat of technological obsolescence of their current mining hardware fleet.
Chapter 7. Conclusion. We have audited the business, challenged the management, dissected the financials, and assessed the risks and tailwinds. We arrive at the final Chapter 7. Conclusion. How do we value Riot Platforms today, trading at $17.83 per share?
We must use a sum-of-the-parts valuation, SOTP. Due to the high noise and non-cash nature of crypto accounting, the FASB mark-to-market rules we discussed, simple multiples like price to earnings are meaningless. We must value the three core components independently: the BTC treasury, the mining operations, and the infrastructure.
Let's start with the hard floor, the cash equivalent.
Okay, 1. The BTC treasury. They hold 18,000 BTC. At the current $95,000 price, that is valued at precisely $1.71 billion. This is our hard floor, essentially a cash equivalent they can deploy instantly.
The mining operations, they are one of the world's largest. What is the standard market valuation for operational halving power?
Riot projects capacity around 38 exahash per second by early 2026. Based on recent sector M&A activity, operational mining capacity is often valued conservatively at around $50 million per exahash of enterprise value. If we multiply 30 ADHs by $50 million, that gives the mining arm a valuation of $1.90 billion.
Okay, 3. The infrastructure and power. This is the component undergoing the re-rating. They have 1,700 milliW of energized capacity. What is the wholesale valuation for that much power?
When power capacity is traded wholesale, especially capacity that requires some level of retrofit or is primarily used for interruptible load, we use a conservative discounted valuation. We will use $1.5 million per MW. If we multiply 1,700 milliW by $1.5 million per MW, that gives the infrastructure component a wholesale valuation of $2.55 billion.
Let's total that up for our base case enterprise value. $1.71 billion plus $1.90 billion plus $2.55 billion.
Our total enterprise value base case is approximately $6.16 billion. When we compare that against the current outstanding share count, that total EV perfectly matches the current market cap of approximately $6.2 billion at 17.83 cents per share.
So if the stock is currently perfectly priced based on today's known assets, the Bitcoin they hold, the mining fleet, and the wholesale value of their power, where is the margin of safety? And where is the growth option that justifies the $26 price target that Piper Sandler set?
The margin of safety is that the market is paying a wholesale price for an asset that is in the process of becoming a high multiple retail asset. The market is capitalizing their 1,700 milliW capacity at $1.5 million per MWD, which is the value of an intermittent, subsidized energy asset tied to the ERCOT grid.
But the AMD deal proves that capacity can be leased as highly reliable, long-duration digital infrastructure. Why does that change the capitalization rate so much?
Because the quality of the cash flow skyrockets. The market capitalizes the stable, guaranteed lease payment stream, which behaves like a bond, at a much higher rate than it capitalizes intermittent, volatile commodity revenue. When an MW is leased to a creditworthy entity like AMD for 10 years, its capitalized value jumps from that wholesale $1.5 million per MW to anywhere from $5 million to $10 million per MW. The AMD deal proves the conversion thesis.
So what's the bull case SOTP valuation if the pivot succeeds?
If Riot successfully converts just 30% of its total capacity, say 500 millido to AI-HPC hosting over the next 3 years, using a conservative $6 million per MW capitalization rate for that leased capacity, the infrastructure bucket triples in value.
Let's run that calculation. The BTC treasury remains $1.71 billion. Mining remains $1.90 billion. But the infrastructure bucket now has 500 milliW valued at 6 MMW, which is $3.0 billion. Plus the remaining 1,200 milliW at the old 1.5 MMW rate, which is $1.8 billion.
That gives us a new infrastructure valuation of $4.8 billion, adding the three parts. $1.71 bits plus $1.90 plus $4.08 gives us a total intrinsic value of approximately $8.41 billion in this mild bull case.
And what if we push that to the full upside potential, assuming greater adoption and faster conversion, aligning with that analyst's $10.6 billion valuation?
The total intrinsic value of $10.6 billion translates to a share price of approximately $32. This is the core takeaway. At $17.83, the market is purely paying for the assets you can already see and count, the BTC treasury and the mining hash rate. The massive upside potential of becoming a critical infrastructure developer for the AI revolution is effectively being acquired for free. This transition creates a significant margin of safety and immense growth optionality.
This has been an incredibly detailed breakdown of a monumental corporate pivot. The landscape has fundamentally changed today.
Undeniably, Riot is now a dual-engine company, a fortress-balanced Bitcoin miner, and a proven landlord for the artificial intelligence revolution. The regulatory environment, through the tariff exemption, is acting as an unexpected structural tailwind, and the capital allocation is visibly maturing.
We spent a lot of time focusing on the Rockdale site because that's where the AMD deal is being physically executed. But for the listener to consider tonight, think about the immense scale we discussed in Chapter 1. Rockdale is the proving ground, but their Corsicana site is scaling toward 1 GW, potentially 1,000 megawatts.
That's the next great optionality. If the Rockdale pilot site validates the critical load performance and the financial model, Corsicana becomes the logical staging ground for the next round of multi-billion-dollar hyperscale deals. That 1 GW site is the path to the $32 valuation and beyond.
Like and subscribe to Stock Analytics AI.
And remember, this deep dive is based on AI-researched, publicly available information and rigorous analysis only. This is not financial advice. Do your own research, but keep a very close eye on that ROT ticker. We'll talk again soon.